In this session, we will deal with the basic concepts of portfolio management, right from understanding what is meant by a portfolio, on what basis we can construct a portfolio, and even go to the extent of why a portfolio is typically required. So we have a lot of things to cover as a part of this session. So before we actually start off with the portfolio analysis process, there is a concept which drives the world of portfolio management, which is called as a mean variance analysis. As we are very clearly understanding, finding out the mean of the securities and the variance of the securities plays a very key role in the portfolio management process. So any security we are looking at, computing the mean returns of it, computing the variance of returns for it, and of course along with that the covariance and correlation. So when I am able to do these kind of calculations for individual securities as well as between the pairs of securities, I can do a better portfolio management. That is what is the base of this mean variance analysis, wherein it makes a conclusion saying the risk versus the return. People can compute the return vis-a-vis the risk based on the expected returns of the securities as well as the variance of returns of the securities. Along with that, they try to find out the correlation and from there the covariance between the individual securities, between the pairs of individual securities, and this helps them in creating the portfolios. That is what is the base for mean variance analysis, which has given a starting point to the world of portfolio management, or to the world of creation of portfolios. And some of the major assumptions that are built into this model are: one, all investors are risk averse, means unless there is a compensating return, no investor wants to take a higher risk. It doesn't mean that all of them are low risk taking, but an investor might go for higher risk only if he knows that there is a possibility. I'm not talking about a guarantee. Only if he knows that there is a possibility of getting a higher return. So only when he thinks that the expected return is going to be high, then only there is a motivation for taking a high risk. So that is one major assumption underlying this mean variance analysis framework. And people can compute all these values. Everyone can compute the mean of each of the securities, the standard deviations, the variance, or even the covariance of all the pairs of securities quite comfortably, and they base their decisions purely on this. Means most of the investors are rational enough, they can do appropriate calculations, and based on these calculations they can take their investment decisions. And of course as most of the models we have seen, even this model goes with an assumption that there are no taxes and transaction costs. So typically buying and selling can happen in unlimited amounts, and people can create their own home driven kind of portfolios also because of this reason. Now, when we are looking at a portfolio containing only two assets, what we are looking at is the expected return of the portfolio is simply the weighted average of the individual returns. Whereas when it comes to the variance, it's simply not the weighted average. It even contains a covariance term between them. And this covariance term is what is the basis for portfolio management or reduction of the overall risk. Reduction of the overall risk by combination rather than the simple summation of the individual risk or simple weighted average of the individual risk. So in a way it is simply saying that when I am combining two securities X and Y in some proportion, let's say some 30%, 70%. So means I'm investing 30% of my money in X and 70% in Y. So the expected return of the portfolio will definitely fall in between the expected returns of X and Y. Definitely fall. Whatever is the combination we are choosing, the expected return of the portfolio will definitely fall between X and Y returns. Whereas when I am looking at the variance of the returns, it cannot be more than the highest variance, but it can definitely be lower than the lowest variance out of the two. I can combine the two securities in such a way, probably the 30-70 or some other combination, it can pull down the total variance below the lowest of the two, below the minimum of the two, whereas the total return, the expected return of the portfolio will always lie in between the two. That is the base of portfolio management, wherein this is also giving me a conclusion that by small compromise on the return, we can reduce the risk drastically by doing an optimal combination of investment in the securities. So that is how we get into. So that's what can be found out using the covariance, which is again based on the correlation between the two securities. So we all know that the covariance between the two securities is nothing but the correlation between the two multiplied by their individual standard deviations. So if the correlation is very much positive, like close to +1, then the portfolio is not effective. But if the correlation goes away +1, probably reaches very close to -1, the variance, the risk of the portfolio comes down drastically, which is what can create a kind of a diversification benefit for us. This is what we'll see now. And the same thing can be applied to a 3-asset portfolio. When I talk about the expected return in case of a 3-asset portfolio goes like W1R1 plus W2R2 plus W3R3. Whereas when it comes to the variance, W1 squared sigma 1 squared. So individual variances, the square of their weightages, W3 squared sigma 3 squared. Now pairwise covariance, 2W1 W2, covariance between 1 and 2, 2W2 W3, covariance between 2 and 3, plus 2W1 W3, covariance between 1 and 3. So this is what will become the variance of the portfolio in case of 3 assets. Now let's take one simple example to try to find out the correlation, using the correlation, how do I find out the mean and the variance of the portfolio, right? Okay, I have taken a very simple scenario saying the expected return of the first security is 10%, whereas for R2 it is 20. So the return wise, the second one is giving a more return compared to the first, but it is more risky also compared to the first, because the expected risk, the standard deviation in the first case is 15, whereas in the second case it is 25. And I am expecting that the correlation between the two securities is 0.5. So when the correlation is 0.5, I can find out the covariance between them, which is nothing but the correlation multiplied by the standard deviations of the individual securities. So the covariance is coming out to this number, and in some cases I require the variance also, so I'll also compute the variance of 1, which is nothing but the square of the standard deviation, and similarly the variance of the second is also, the variance of the second one is the square of this standard deviation. So let me use these two numbers also, so that I can use at some point. Now I am expecting that I will invest some W1 in the first one, and the remaining I will invest in the second. So probably here W2 I will call it, but it would be 1 minus W1. So I will take some scenarios. If I am investing 0% here, then it's as good as saying I am investing 100% here. So similarly I'll take 10%, right? Like that I will do 0%, 10%, and let me take this up to 100%. And based on this, even this will become 1090. So here I want to find out the expected return in each of the cases. So the expected return of this combination is W1 R1 plus W2 R2. W1 R1 plus W2 R2. So for this combination, the expected return is coming out to be 20%. Similarly, I can do for all of them. So I could see that the expected return is always lying between the minimum return and the maximum return. Whereas if I want to try to find out the variance of the portfolio, W1 squared, sigma 1 squared, okay, so W1 squared, sigma 1 squared is the variance of 1 plus W2 squared, variance of 2 plus 2 W1 W2 covariance between 1 and 2. So this is what is coming out as the variance of the portfolio. So this is what is the variance of the portfolio. Now you see here the minimum of the two variances is 0.0225. Whereas if you see here, I am able to create a portfolio with 0.0222 variance, which is lesser than the minimum of the two. Right? I am able to create a portfolio with a variance of 0.0222 like this. So what we are saying, but the return is not lesser than the two, but the risk I am able to reduce it much lesser than the individual risk of the two securities taken together. Right? Lesser, it lesser than the minimum of the individual risk. That is what we are trying to drive as the benefit of the portfolio management. Now When I try to plot, okay, now that I know the variance, I'll take the standard deviation, which is nothing but the square root of the variance. Okay, I'm taking the standard deviation, and now let's say, so if I express it in percentage form, things will be very clear for you. Here you are able to see that I'm able to get it to 14.91%, whereas the individual standard deviations are 15 and 25. Right? Whereas the return at any point, it was not at that layer at all. So generally what I can think of is, I can think of plotting a graph. Right? Now I'll think of plotting a graph between the standard deviation and the mean. I'll take the standard deviation on the x-axis and the expected returns on the y-axis, and I plot a kind of a scatter plot. Okay, I want to plot a scatter plot now. I'll look at it here, and yes, in this scatter plot I'm looking at, so the risk versus return is the name I'm putting to this graph. So the x, when I'm looking at x, I'll take the standard deviation on the x-axis, and when I look at y, I'll take the expected returns on the y-axis. So this is a kind of a graph that I am getting. Okay, so let me just expand it a little bit more. I get it more like a curve, but if I do it a slight more modification, okay, okay, so when I'm doing some kind of modifications here to the numbers, I'm seeing that the risk versus return graph is coming more like a curve instead of a straight line. We'll discuss about this curve slightly in a while from now. It is actually this kind of a curve is what we call as the minimum variance frontier. So we would be calling that particular curve as a minimum variance frontier. I'll tell you why we call that. But whenever I try to take the risk of the portfolio and the return of the portfolios, and I plot a graph between the standard deviation of the portfolio and the mean of the portfolio, this kind of a curve gets generated. The same thing happens when I do it with the three assets also. But when I do it with the three assets, it becomes very complicated. Okay, let me just try it for you. Right, when I have to do it with three assets, what happens is, okay, let me take R1, R2, let me take some numbers, R1, R2, R3, then the variance V1, V2, or probably I'll take the standard deviation, SD1, SD2, SD3, and okay, R1 I am taking as 10%, SD1 I'll take as 15, R2 I take as 15%, SD2 I take as 20, and R3 I take as 20%, and SD3 I take as 25%. Let's say I am taking three such kind of securities. Then correlation between 1 and 2, I take it as 0.2. Correlation between 2 and 3, I take it as 0.5, and correlation between 1 and 3, let's say I'll take it as 0.75. Some such numbers I am taking. Now, so because the standard deviations are like this, I can find out the variances. So this is a slightly tedious process, but I'm just driving the show for you. Okay, these are the variances. So I'll call this as V1, V2, V3. And from here I can find out the covariance. Correlation times the standard deviation of 1 into standard deviation of 2. Correlation times standard deviation of 2 into standard deviation of 3. Correlation times standard deviation of 1 into standard deviation of 3. So these are the covariance between 1 comma 2, covariance between 2 comma 3, and covariance between 1 comma 3. So these are the numbers. Now let me assume some combination. So I'll say W1, W2, W3, right? Now I don't know, so probably if I say 30%, 50% and 20%, something like this. Now what will happen? What is the expected return? So I'll take the expected return in this case. I'll take the expected return in this case as W1 R1 plus W2 R2 plus W3 R3. So this is my expected return, and the same thing when I'm looking at the standard variance of the returns, variance of the portfolio, W1 squared, variance of 1 plus W2 squared, variance of 2 plus W3 squared, variance of 3 plus 2 W1 W2, covariance between 1 and 2, 2 W2 W3, covariance between 2 and 3 plus 2 W1 W3, covariance between 1 and 3. So you think here that if we have just 3 securities, this is the kind of effort that is going on in deciding what is the expected return and what is the variance. Especially in terms of variance, it becomes quite a tedious process, right? This is the variance of the portfolio. So if I want the standard deviation of the portfolio, I'm just taking the square root of the variance. Fair enough. So now what I want is, when I'm changing the combinations, when I'm changing the combinations of investments, my expected return will change and my variance will change, right? So the thing is, now I'm interested in creating a kind of a portfolio where, let's say, if I want 11% return, 12% return, 13% return, and so on up to 20% return, what is that minimum value of the variance that can exist for each combination? We have a tool called solver which can does that particular scenario. Let's say it cannot be done manually. All I am trying to do is, okay, I want 14.5, just to demonstrate to you what we are doing here. See, if I want 14.5% return, is this the optimal combination, 30, 50, 20, or is there any other combination of W1, W2, W3 which will reduce the risk below 15.7. Is there any other combination which will reduce the risk below 15.7? That is what we are trying out for each level of risk. For each level of risk, for each level of return, I'll try to find out what is that amount of, what is that combination of weightage which will reduce, which will give me the least possible risk. I have to do it with iterations. I have to make sure that my return is still 14.5, but this number has to come down drastically. So those are some of the things. So I'll just, we have to solve it through systems itself. So just to show, I have a tool called solver in Excel where I want to set this particular value, standard deviation, to be minimum by changing the weightages. Where I want to fix, here I want to say that all these three should be less than or equal to 1, and I want to say all these three should be greater than or equal to 0. Here we are not going with the possibilities of shortings, and this number I'll say should be equal to 14.5% only, which means for 14 corresponding to 14.5%, I want the output to be generated. What is the possible combination which will reduce or which will minimize the error? Is there any way the error can get below this particular number? Okay, so now when I am doing it and solving it, we get a better result saying yes, the same 14.5 can be obtained in case you have gone for 42.09% in W1, 47, almost 46.76% in the second one, and 16.38 in the third. That would have still given you 14.5% return, but that will bring down your risk to 15.64. Earlier the risk was 15.7. So what we are trying to say using this is, for each level of return, there are different possibilities existing. Different weightages, different combination of weightages can give me the same level of return, but they are having different levels of risk. Now, this concept of minimum variance frontier, what it says is, for each level of return, I will try to identify which one is the least possible risk. Just like in the earlier case, for each possible return, I will try to identify. In case of two asset portfolio, this is straightforward. This is what I call as minimum variance frontier. Because you see here, if I have to get a return of 18 in case of two assets, there is no other way. I have to combine it in 2080 only. So there is only one way possible in case of two asset portfolio to get 18% return. Whereas in case of more than two assets, I have so many ways. So that's the reason when I talk about a two asset portfolio, this minimum variance frontier is easy to draw. Whereas when I look at more than two assets, it becomes very difficult, because the minimum variance frontier is nothing but for each level of expected return, what is that minimum risk that can be incurred, and plot a graph between the risk and the return. Just like the way we have done in case of two asset portfolio, plot a graph between the standard deviation and the return, where for each level of return we get a minimum most risk possible. And so for understanding purpose, we can always understand from a two asset portfolio, because the shape of the graph will come more or less similar. the shape of the minimum variance frontier always comes like something like this. So for here I have the standard deviations and here I have the expected return. Now for each level of expected return, this point is the minimum most risk. For this expected return, this point is the minimum most risk. For this expected return, this is the minimum most risk. For this is the minimum most risk. So when I join all these points, it actually comes in the form of a curve, and this particular curve is what we call as a minimum variance frontier, and each point on this curve is a minimum variance portfolio corresponding to. So just to check out once more, probably in this, okay, instead of checking out for 14.5%, the same solver, let's say I want to change it for 15%, right? Just I want to show one for you. Let's say I want to show for 15%. 15% being the expected return. Okay, so now it has changed 44, 48, 17. This is what is the combination that it has come out to. Okay, here I have to make one more modification. Looks like the sum of this weightages should be equal to 1. One more rule I have to put, otherwise it is increasing the weightage for me. So I'll take the sum of this. Okay, now it is 109%. So probably let me do it something more better. Add one more rule saying that the sum of this weightage should be equal to 1 only. So when I put one more rule, it may so come up. Yeah, it has changed the combination. 28, 45, 28 will produce 15%. You could have very well said, I could have invested all 100% in second security itself. Even that will give me 15%. But what the portfolio management process is telling me, or what this mean variance framework process is telling me is, if you invest all 100% in R2, the standard deviation is equal to 20%. Whereas if you had invested 28, 45, 28, the mean is still 15%, but the standard deviation is only 16.26%. You have reduced your risk for the same amount of return. So for different levels of risk, we are going to get different levels of return. So for each level of return, when I am able to identify that particular minimum risk and plot a graph like this is what is going to lead to the minimum variance frontier for me. And it's very easy when we are dealing with two asset scenario, but when we are dealing with more than two, just like what I have explained now, find the expected return, variance for each security and the covariance. We have taken that data. Take a set of expected returns, okay, 11%, 12%, 13%, take a set of expected. For each expected return, find out using a tool like solver, what is that combination which will reduce or which will minimize the standard deviation or the variance of this portfolio. So that particular combination of the three securities is what will give the minimum most standard deviation. So take that standard deviation and the return which you have fixed and plot the point and join all the points, which will give me a kind of a minimum variance frontier curve like that. And out of this particular point, which looks like the minimum most variance of all the portfolios I am looking at, this is the minimum most variance, which I actually call as the global minimum variance portfolio. This particular point is what is called as the global minimum variance portfolio out of all the ones, because this is having the least possible risk out of all the various possibilities. So this is one important concept that needs to be comfortable with respect to the portfolio process. Okay, then moving on to the next one. On the same lines, we even discuss about a concept called efficient frontier. Now, when I looked at the minimum variance frontier, let me give a better picture now. This was the graph, right? Here we had standard deviations and here we had the expected return of the portfolio. So for each return, there is only one standard deviation. So I can say this is the minimum most standard deviation associated for each level of return. But look at it from this side. For each level of risk, there is a possibility of two on the same minimum variance frontier. If I look at it from this side, from this, for this particular risk, I have two different points, two different levels of return. For this particular risk, I have two different levels of return, which means a person who is willing to take this much of risk, obviously he will not prefer this, because we assume that all the investors are risk averse. So the investor will not go for this kind of security at all. He would like this kind of a portfolio at all. Rather, he would prefer this portfolio if he is willing to take this much of risk. The same logic extends. If I look at it from a risk standpoint, there is a possibility on this minimum variance frontier. There is a possibility that for one level of risk, there are multiple levels of returns possible, and obviously as a risk averse investor, if he is bent upon taking some X amount of risk, he would like to want the maximum possible return for that level of risk. So when I look at this minimum variance curve, only the upper portion after the global minimum variance portfolio, the upward sloping portion, or otherwise called as a concave portion. The upward sloping portion of this minimum variance portfolio is what I call as the efficient frontier. Because from the investor's perspective, if he is taking increased amount of risk, he wants increasing amounts of returns. Whereas for the portfolios which are on the convex side or below the global minimum variance portfolio, as the risk is increasing, the expected returns are decreasing. So investor cannot go forward looking at those portfolios at all. So on the convex side of the minimum variance portfolio, all the portfolios are inefficient, whereas on the concave or the upward sloping side, we call those portfolios are efficient, and that line is called as, and that curve is called as the efficient frontier curve. So the upward portion of the minimum variance frontier curve is what we are calling as the efficient frontier. And as I am saying, as the risk levels of the individual investor are increasing, appropriate portfolio can be chosen for that particular. So if he is willing to take this much of risk, this is the combination of the portfolio which he can very well take. So he can expect this kind of a return, and for this return, how much he should invest in each of those securities can very well be understood. So for each level of investor, for each risk taking level of investor, as the risk is increasing, the return will increase on the efficient frontier. So the selection of the portfolio will be reflected accordingly. All right. So let's move forward. Then we will try to understand the concept of diversification here The simple way I define the word diversification is reducing the risk. Right? By adding more and more securities or by creating a portfolio, I am able to reduce the risk. And there are two ways I can reduce the risk. One is by selecting the securities which are not that correlated with each other. The correlation between the securities goes lower and lower. So even if I am selecting 3 securities, if the pairwise correlation between them are very low, the overall variance and the standard deviation will come down drastically, means my portfolio is well diversified. Just to add to this example here, look at the two variable or two asset portfolio here. The minimum most standard deviation I am seeing here is 13.89 for a 80-20 combination. But let's say if the correlation between these two is minus 0.5 instead of positive, all I could see now is the minimum most standard deviation which I am able to bring is 9.37. Earlier it was in 13, but now I am able to bring it much lesser to 9. Means if the correlation between the securities is very much down, I can reduce or even very close to -1 or at to whatever extent it is lesser, I can reduce the overall variance. Even if we see here, instead of all of them being positive, let's look at least one of them being a negative, or probably all of them being negative. You see the overall standard deviation is brought only to 0.05 by this combination, which is only 5%, whereas even if let's say one of them is positive, you are seeing the correlation is 0.10, then 0.15 and 0.16. So it all depends. If the correlation between the securities is coming down, there is a good diversification benefit that I can create. And the second way I can create more diversification benefit is by adding more and more securities to the portfolio. Now, yes, just a little bit of more demonstration here. You see here, when the correlation was negative, you find that the curve is very much significant. You look at minus 0.8, even more significant. -1, perfectly negative. It's almost touching the y-axis. There's a huge diversification benefit. 0.5, diversification benefit is almost lost. 0.8, almost becoming a straight line. And when it is 1, it becomes a straight line, saying there is no diversification benefit in any case. Right? And the other thing, as I was talking of, is I can have the more the number of securities in the portfolio, it can create a very high diversification benefit. But of course, the variance will come down, right? Adding more and more securities, the variance of the portfolio will come down, but it will come down at a decreasing rate. Probably initially when there are 2, the variance is this much. For the next, variance is 20%. The minimum I can bring down the variance is 20. But I brought in the third security, I was able to bring the variance to 17. When I add the fourth security, I am able to bring it to 15. The next one I am able to bring it to 16.5. The next one 13.5. The next one I am able to bring it down to 12.5. The next to 12. So I am not able to bring it anywhere below, let's say 12 or 11 or something. So adding more and more securities provides the diversification benefit, but at a decreasing rate. Means beyond a certain number of securities, even if I am adding, there is no additional diversification benefit that I am going to create, because the overall portfolio's standard deviation will be the same as will be very much closer to the standard deviation in the entire market when I combine all the securities in proportions of their values. Whatever is the standard deviation that is getting generated, this will be more or less replicating that, which means adding any more securities, the extra value addition that I am able to create with respect to portfolio diversification is almost negligible. So after that point, it's not worth to add additional securities, because it can only increase our cost, but it cannot provide any more diversification benefit for us. And okay, if there are more and more securities, as we have discussed, finding the variance of a portfolio is a very tedious process, because I have to find the variance of all the individual securities, and then the correlations and the covariances between each pair of securities, and then only we can find the variance of the portfolio. So if there are probably n securities with us, I need to find n variances and n into n minus 1 by 2 covariances. So these many values need to be found out to find the variance of the portfolio. So the other side is, if at all I am able to build an equal weighted portfolio, then probably the concept of, instead of W1, W2, so now if I want to simplify it, okay, if I want to simplify this, right, I want to simplify this. So W1 squared sigma 1 squared plus W2 squared sigma 2 squared, so on, plus Wn squared sigma n squared plus 2W1 W2 covariance between 1 and 2, 2W2 W3 covariance between 2 and 3, and so on. Now here the W1, W2, all of them I am making equal by making it a equal variance portfolio. So the weightage of each one will become 1 by n. So 1 by n squared sigma 1 squared plus 1 by n squared sigma 2 squared. So that is what is happening to the variances, which means 1 by n squared into sigma 1 squared plus sigma 2 squared plus sigma 3 squared. So summation of all the variances. Or if I take 1n out, summation of all variances by n, which is the average of all variances. So the average of all variances is sigma average square divided by n. And similarly here also 2W1 W2, so 2 into 1 by n into 1 by n, so it becomes 2 by n square. And how many such covariances are coming? N into n minus 1 by 2. So again, as a simplification, it is coming out that 2, even this 2, so 1 by n into the average covariance, whatever is coming out. So average covariance divided by n into n minus 1. So whenever I am going for an equal weighted portfolio, that's where I said the variance of the portfolio is average of all the individual variances plus average of all pairs of covariances multiplied by n minus 1, because this is becoming average divided by is okay. So average of individual variances by n average of all pairs of covariances by n into number of securities minus 1. So as the number of securities is increasing, okay, now you see what is the formula for, now if I simplify it, the average, the variance of the portfolio is becoming the average of all the securities variances, the average variance of all the securities plus average covariance of all the securities by n into n minus 1. So now if n is very large, this will become 0. 1 by infinite is 0. And whereas this will become, these two will become, the division of n minus 1 by n will become 1. So which will be equal to average covariance. So that's where I said, as the number of variances increase, the variance of the portfolio is equal to the average covariance. So I don't have individual variances playing any role as the number of securities in the portfolio increase. And so which means the maximum risk reduction that can happen is based on the average correlations only, because it is based on average covariances, and average covariances are based internally on average correlations. So if the correlations are lesser and lesser, obviously I'm able to reduce the variance of the portfolio quite drastically. But it is also said that it requires more number of securities to realize the maximum diversification benefit. So in case of equal weighted portfolio, if the average correlation is much lesser, yes, the diversification benefit will be very high, but it requires large number of securities to bring down that to bring down the portfolio's variance to that of the maximum diversifiable variance that can be obtained in the process. So that is what is the intention in terms of portfolio management using the mean variance framework, wherein I am identifying for a suitable weightages which can reduce the overall variance of the portfolio. Now let's extend this analysis by adding a risk-free asset to this portfolio, because till now whatever the discussion is, it is based on two or more assets which have some level of standard deviation built into them, which means the portfolio whatever we have built till now is a risky portfolio wherein the minimum variance cannot be below a particular number, right? Probably in whatever combination I combine that particular asset, the portfolio variance or the standard deviation cannot come down below this level, right? So then if there are investors who want to position themselves at these layers of risk, then this combination of the risky portfolio is not going to do any kind of a benefit for them. And of course everyone don't want to put 100% of their assets or 100% of their investments in the risky portfolio. So they would like to put, yes, 60-70% in the risky portfolio, depending on their risk taking potential. They would like to put some proportion in the risky portfolio, and the remaining proportion they want to move into a risk free kind of investment. So this is what is the next thing which we are going to deal with. If I try to add a risk free asset to this risky portfolio, how should I look at it? And okay, let me try to deal it in the same example. So here the risky portfolio wise, right, let's look at the two asset scenario. The risky portfolio wise, we have various combinations of the risky asset. We have various combinations of the risky asset which are giving rise to different standard deviations and different variances, and which is what is our minimum variance frontier also. Now let me choose one of these. So let me choose the one which is having the least possible risk out of this. Okay, so let me choose this combination. We'll choose two more. Okay, if I'm choosing this as the risky portfolio, and now what I'm doing is I would like to bring up the risk-free asset as one of them, and the risky portfolio as the other one. So the return on the risk-free asset, let me assume some risk-free rate of return, some 8%. 8% is the, so this risk-free is nothing but kind of government short-term security which does not carry any kind of a risk, generally equated with the treasury bill rates. So risk-free rate of return 8%, whereas when I am taking on the risky security, or here the security is the portfolio, so I'll take that this is 12%. Similarly, when I take the standard deviation for a risky security, risk-free security, the standard deviation is 0, whereas for a risky security this is becoming 13.89%. And based on this, okay, I also say that the correlation is always 0, because whatever may be the changes in the risk-free return, in the risky returns, the risk-free return is going to be constant. So if the standard deviation is 0, the covariance of that with respect to anything can be taken as 0 directly. So because of this, now let me bring out various combinations, 0%, 10% in this risk-free. In this risk-free, if I say I am going to invest something in this form, right? Whereas in the risky asset, I want to invest 100% minus this. So in the risky asset, I want to invest something like this. So I can find out the expected return now. I can find out the expected return now, saying W1 R1 plus W2 R2. Okay, so these are the expected returns. Similarly, I can find the variance of this portfolio, W1 squared sigma 1 squared plus, okay, here W1 squared, sigma 1 squared is 0, so that will not work. W2 squared sigma 2 squared, then 2W1 W2 correlation is 0, so covariance is 0, so the third term also will not exist. So the variance is coming out to be something like this, right? Okay, the variance is coming out to be something like this. So from there I can get my standard deviation is nothing but the square root of this variance. So these are the standard deviations, and now the same way as I have executed earlier, I'll take one simple graph between the standard deviation and the expected returns, just like the way I have looked at earlier. After I bring in a risk-free security, I am looking at the risk versus return this time. I'm looking at the risk versus return, where the standard deviation I'm taking on the x-axis and the expected return is what I'm taking on the y-axis. Now here what I'm getting actually is a kind of a straight line. Yeah, here the interesting point that I want to see. So this is a straight line which is intersecting the y-axis at 8%, which is nothing but the risk-free rate. So in this case, the y-intercept, is the risk-free rate of return. Now, look at this. When I chose 80-20, yeah, I'm able to get something like this. Now let's say I want to take, instead of 80-21, I want to take a slightly different combination this time. The portfolio which is slightly different. So let me take a 50-50. So the expected return is 15 and the standard deviation is 15.81. So based on this also I can compute the expected return and the standard deviation. Right, I can compute the expected return and the standard deviation based on this combination also. So here comes W1 R1 plus W2. This time R2 I'll take as this. Okay, W1 R1 plus W2 R2 is something like this, and the standard deviation of the portfolio are probably here. I don't need the variance because only one term is there, which is sigma 2 squared, sigma 2 squared, W2 squared, sigma 2 squared. That's the only thing, because W1 squared, sigma 1 squared is 0. 2W1, W2 covariance is also 0. So all I am left with in variance is W2 square sigma 2 square. The standard deviation is nothing but W2 sigma 2. So it's a straight line. So W2 sigma 2. So this is the standard deviation, right? Let me just reduce it. So this is going to be the standard deviation in this case for all these. Now let's look at something interesting. Okay, look at this. Both of them, they are having the expected rate at 0 for a standard deviation of 0. So even if I had superimposed that graph on the top of this graph, it could have started at 8 for x is equal to 0 itself. But look at something else. Corresponding to let's say 10, expected return of 10, the standard deviation is 6.95, or let's see if there is any close. Yeah, let's look at this. 11.07 standard deviation and 11.11. So almost the standard deviation is the same, right? 11.07 and 11.11. So on the x-axis here, the same 11% will be the point. And look at the returns corresponding to that. So for the second one, the return is 12.9, means somewhere here. For that same 11%, Here the return is coming out to 12.9, whereas in this case, this for the same 11, the return is only 11.2, which is on this line. So when I join this line, it is actually coming out as a slightly higher line. So now, if I look at it, the initial line which came out when we took 80-20, this was the line. But when I have taken 50-50 as the asset, right, for the same 11.07 standard deviation, I am getting 12.9 is the expected return. So obviously this line is going to be something like this. And for a different combination, the line could be something more, either this side or this side. So depending on the different combinations of the risk-free, different combinations of the risky asset that we are choosing, we are getting different straight lines, right? But we are getting straight lines only. So that kind of a line which we are getting by holding a combination of a risk-free asset and a risky asset. Whenever we are holding a combination of risk-free and the risky assets, we are getting different kinds of lines depending on which combination of the risky asset we are typically taking. Now obviously any investor will want to have a much higher risk reward ratio. See, the slope of this is actually showing the risk reward ratio. If you just look at it, the higher the risk I am taking, obviously in all of them, the higher the risk I am taking, the return is increasing. But if this is more flatter, the expected return is much is growing at a much lesser rate. But if this return is steeper, if this graph is steeper, then the expected return for a little bit of additional risk is going to be much higher. So the reward to risk ratio is much higher in this case. So any investor for that matter, he may not choose all these lines. He may choose only this particular line. And this particular line, which is having the highest risk to reward to risk ratio, is what we call as the capital allocation line. So when we are combining the risk-free asset with a risky asset, there is a possibility of getting many risk return lines, but out of them, one combination which is having the highest possible reward to risk ratio is what will be chosen by the investor, because as he is going higher and higher in terms of risk, he wants to be rewarded more for that. So the one that, see, if I am looking at, I am taking this much of risk, I want this much of return rather than this much. So out of all these lines, the one that is going more and more steeper is most preferred out of that list of securities, and at the same time, whichever is the one that lies on the as a tangent to the efficient frontier. Now that's where we bring in one more. Now for that same set, for the same securities combination, if I am taking the graph of an efficient frontier, now the better way to look at it is like this. Now this is the efficient frontier for this security. What I'll do is, if I draw a line from this 8%, if I draw a line from this 8%, whichever line, now I'll have so many lines going like this, right? If I keep drawing lines, straight lines, there are so many lines that go. So let's say this is the efficient frontier and this is the risk-free rate. I can have so many lines going like this, and this particular line Even these will not be effective. This particular line which goes as a tangent, this we cannot even generate. This particular line which goes as a tangent to your efficient frontier comes as your capital allocation line. So the risky portfolio that maximizes the return to risk, reward to risk kind of a ratio will be chosen, and that reward to risk ratio in that case is nothing but, see, what is the excess return you are getting? Whatever is the return on portfolio minus the risk-free rate of return, that is the excess, and the excess risk which you are taking is the standard deviation. So which is by definition nothing but the Sharpe ratio. So whichever that combination of the risky asset, so in this case, all right, if I am looking at the combinations, if I am looking at the Sharpe ratio in each of these cases, which is nothing but the expected return minus the risk-free rate of return, which is 8%, divided by the standard deviation of the returns. Right? In this case, it will definitely be the same across. If we see here, it is the same across because it's a slope of that particular line. Whereas for this combination, if I am looking at the expected return minus the risk-free rate of return divided by the standard deviation. So from here, let me do expected return minus the risk-free rate of return divided by the standard deviation. So almost 0.44, which means this is a better CAL. This is a better reward to risk line. So in this entire combination also, if I want to check, if the risk-free rate is 8%, expected return minus risk-free rate of return divided by the standard deviation. So this is giving me 0.48. So probably 0.481. So probably 1090 combination is a more effective combination compared to anything else, wherein the reward to risk ratio is higher. In this combination, the reward to risk ratio is much lesser, though it is having the least amount of variance or standard deviation. The reward to risk ratio is much lesser in this case. So the CAL, the capital allocation line, will come out as that particular line which will be a tangent to your efficient frontier, and that particular line will become the capital allocation line. Now, one more interesting aspect from that dimension that needs to be looked at is, yes, if this portfolio is on the efficient frontier, right? Because this portfolio is definitely on that efficient frontier. So this is the optimal portfolio for me, right? Now, so any risk and return up to this layer, these kind of portfolios, all these portfolios, we call them as lending portfolios. Means up to this particular point, I invest some portion in the risk-free asset and the remaining portion in the risky asset. But beyond this, let's say if I want this, right? So let's assume here 8. Okay, if I'm investing 100% in risk-free, I'm getting 8. But if I'm investing 100% in risky, I'm getting a 15% return. And for this, I'm going with these are the risk levels. Let's say if I want to look at a different combination, I invest 120% here, and means if I have to invest 120% here, there is a possibility that my expected return, okay, not in this, sorry. If I want to invest 120 in the risky, so I will invest minus 20 in the risk-free asset. If I am investing minus 20 in the risk-free asset, I am able to invest 120% in the risky, which is going to give me an expected return of 16%, which is more than investing all 100% in it, but it is exposed to a risk of 18. For by taking 18% risk, let's say this is the scenario, this is my efficient frontier and this is my tangent line. Now up to here we call the portfolios as lending portfolios, means I will invest some 50. So if I am talking of this particular portfolio, yes, up to here I can create by investing some portion in the risk-free asset and some portion in the risky asset. But if I want to generate a return something like this, I may have to borrow and invest, and I am assuming that here I am borrowing 20%, so I am investing 120% of the money in the risky asset, which is going to generate a return of 16.4, whereas the standard deviation is around 18.9 in that case. So what we are saying there is, if at all I have to go beyond the point of tangency, we call them as leverage portfolios, where I can create an additional return, I can create extra return on the top of that 15% only by borrowing at the risk-free rate and investing more than 100% in the risky portfolio. And in case that kind of risk-free borrowing is not available, then my CAL, in case that kind of a borrowing is not available, then my CAL is nothing but if this is the portfolio, if the risk-free return is possible, risk-free borrowing is possible, then for this much of risk I'll get this much of return. But if the risk-free borrowing is not possible, then if I have to take this much of risk, I'll get only this much of return. Means I cannot borrow and I am going for entire investment into the risky portfolio itself, which means I am going to get only this much of return, because risk-free borrowing is not available. I may have to borrow at more than risk-free rate. So overall return that I am getting in that case is going to be much lesser. So in that case, actually the capital allocation line will come as a straight line until that tangency portfolio, and after that it follows the path of the efficient frontier itself. So that's one more thing that we have to understand. This is applicable only in case the risk-free borrowing is not possible. And in any case, what is the equation now? You see what is the slope of that particular line? Wherever it is the tangency portfolio, I am looking at the return on the tangency portfolio minus the risk-free rate of return divided by the standard deviation of the tangency portfolio. That is the slope. So when I want to find out the equation, let's say corresponding to any other layer of risk, some sigma c risk, all I can say is y equal to mx plus c. This is mx plus c, that is the intercept. The intercept for me is RF. So RF plus this is what is going to be the return for my combination portfolio, whatever it is, by going with the capital allocation line. So the slope of the capital allocation line will go as the Sharpe ratio of the tangency portfolio, and when each individual have different expectations of the asset returns. Here we are talking about the asset returns. Each asset, we are talking about each individual investor. Okay, I will expect this particular asset. Here we are taking 12 and 15 kind of numbers, whereas different investors for the same, they may expect 13 and 16, something else. So when the investors are having different expectations, there is a possibility of different CALs each for each investor. So CAL, capital allocation line, is more different for each investor, and it is more and more specific to the investors. But under the assumption that all the investors have homogeneous expectations about the returns, variances, so if all these numbers are uniform for all investors, then there is no possibility of multiple CALs coming up. There is only one CAL that comes up, and that particular CAL which comes up where the expectations of the mean, the variance, and covariances, correlations, if the expectations of all these statistical calculations is uniform across all the investors, there is only one CAL possible, and that particular CAL is what we call as the capital market line. Means whatever the tangency portfolio that we are talking of, the risk, whatever the combination of the risky assets also that we are talking of, even this will be only one portfolio, and this portfolio is what we call as the market portfolio, which we call as the optimal portfolio, which every investor will desire based on the expectations, based on the assumption of homogeneous expectations about the mean, variance, and various aspects. So there is only one CAL exists, and that is what we call as the capital market line. And the optimal portfolio, whatever, now it also is only one, which is called as a market portfolio, which is the portfolio based on all the possible assets weighted based on their market values. So again, the slope of that kind of a line, which is also one of the CALs only. CML is a special case of CAL, where the optimal portfolio is the market portfolio. There is only one optimal portfolio, there is only one CAL, because the expectations of the investors are homogeneous regarding the mean, variance, and all other statistical parameters of the particular set of assets. So the slope of that is again the Sharpe ratio, but yeah, the Sharpe ratio of the market portfolio this time. And so even from this, what can come out is the lesser, if at all an individual is more and more risk averse, so the formula comes slightly different. The same, this time I will not take for the slope, I am not considering tangency portfolio, though it's a tangency itself, but tangency under the condition where all the investors have homogeneous expectations about the mean and the variance. So there is only one portfolio of such kind existing, which is called as a market portfolio. So typically the return on the security is equal to the risk-free rate plus this. So this slope is what we call as the Sharpe ratio of the market portfolio. And as the risk is increasing, the return is also increasing. And if at all I am talking of low risk taking kind of an investor, I will prefer maximum proportion to risk-free asset and increase the combination of the risky assets as the risk taking levels are typically going up. So this is one aspect wherein I combine the risk-free asset with the risky asset of the portfolio, and this is what is the linkage we are bringing up between the between the return of the market, risk-free rate of return, and the standard deviation associated with the market portfolio. Now we can take a similar kind of assumption. So basically, whenever we are talking about the capital market line, we are simply saying it's a line which is drawn between standard deviation of the portfolio on the x-axis and expected returns on the y-axis, and coming out as a standard straight line whose slope is equal to the Sharpe ratio. Now the same logic, when we bring into the concept of portfolio, we will break this standard deviation of the portfolio into two kinds of risks. The standard deviation is nothing but the risk, right? So this risk will break it into what we call as the systematic risk and unsystematic risk. Right? We'll extend it more and more to the individual securities by going slightly as an improvisation over the capital market line model. Alright? Now that we know that capital market line is a graph between the standard deviation of the portfolio and the returns of the portfolio. Now, as I said, the standard deviation, which is the total risk, I break it down into the systematic risk as well as the unsystematic. Unsystematic risk is more and more specific to companies, one single security specific, whereas this is specific in the system itself, in the economy, in the market in which we are investing, whereas this is specific to each of the securities. And what I mean by that is, I can very well diversify this unsystematic risk quite comfortably. So there is no price associated. This is also called as non-priced risk factor. Non-priced risk means I am not going to get any additional return by taking that extra risk, because I can very well diversify away that risk. So such kind of risk is what we call as unsystematic risk or diversifiable kind of risk, whereas the systematic risk is actually a risk that is present in the system and it's not that easy to diversify it. So what we are saying now is, when I take it at an individual security level, ignoring this particular risk, if I am trying to plot a graph between the systematic risk and the return on the security, we call that particular line as the security market line, SML. Out of the total risk, instead of taking the total risk, assuming that the unsystematic risk is easily diversified away, so it will be remaining as 0. Instead of this unsystematic risk, if I take only the systematic risk here and continue ahead with this particular model, that kind of a model is called as, that kind of a line is called as security market line. And the line, the equation of that particular line, where I am taking the systematic risk, the systematic risk is also called as market risk because it's a risk that is inherent with the market, or it's also called as non-diversifiable kind of a risk. So if I am taking only that diversifiable risk on the x-axis and the returns on the y-axis, whatever the graph I am going to create, I call that particular graph not a capital market line, it's a security market line specific to a security. And this equation is called as capital asset pricing model equation. The equation, the line equation which is corresponding to this security market line is actually called as the capital asset pricing model. And as a measure of this systematic risk, we take a measure called beta. Beta is a relative risk with respect to the market. If it is equal to 1, it is same as the risk of that security is more or less equal to that of the market. Lesser than 1, less risky than the market. Greater than 1, more risky than the market. So what is coming out is, it is a measure of a systematic risk. So instead of taking sigma or something, here if I am taking beta, that is what is giving rise to this capital asset pricing model. So let me try to derive that equation for you. Okay, let me take 3 scenarios. When the risk is 0, risk is 0 means even the beta also will be 0, right? The return which I am going to get is the risk-free rate of return. When the risk is 1, or when the beta is 1, beta is 1 means it is having the risk is similar to that of the market risk is similar, the securities risk is similar to that of market risk. So whatever the return that you are expecting is the market return. So for a point 0 on the x-axis, the return is risk-free rate of return. For a point 1 on the x-axis, the return is the market return. Then for any other beta, either more or less, for any other beta called beta, let's say the return is the return of the portfolio or return on the security I. Now using these 3, I want to find out the slopes of the equation. So using these 2, I will find one slope. Because it's the same straight line, the slope has to be the same. So using the first 2, what is the slope? Difference in the y's by difference in the x's. Rm minus Rf by 1. So the slope of this line is Rm minus Rf, which is nothing but a market risk premium. Because the return of the market above the risk-free rate of return, that is what is coming as a slope. But if I take these 2 as the slope, these 2 points to compute the slope, I am getting it as Ri minus Rf by beta. This is what is the slope. But for a line, the slope should be the same. So I will equate this to Rm minus Rf. Working out with small algebra, it comes Ri minus Rf is equal to beta times Rm minus Rf, and from there I get Ri equal to Rf plus beta times Rm minus Rf. So that is the typical equation of this security market line, which is what is called as the capital asset pricing model. The return on any security is equal to the risk-free rate of return plus whatever is the market risk premium times the beta of that particular security with respect to the market. So to build this capital asset pricing model, the assumptions again more or less similar to your mean variance framework. So people have to find out the expected returns, variances, and all investors have good amount of understanding about all of them. Apart from that, all assets are marketable perfectly. I am able to sell all kinds of assets quite comfortably and quite competitively. All individuals are price takers. Their buy-sell decisions don't impact the prices quite heavily, and the individuals can borrow and lend at the risk-free rate for unlimited amounts. They can do short selling to whatever extent possible, and no taxes and transaction costs. And because of all these things, the market portfolio, again, because we are dealing with the uniformity of expectations of the investors. The market portfolio is the same risky tangency portfolio, only one existing. So the line that is providing the relationship between the beta on the x-axis and the return on the y-axis is what we are calling as the security market line. And the slope of that, as I have just now discussed, the slope of that security market line is market risk premium, and probably it is also equivalent to a trainer ratio. And the intercept is the risk free rate. It's a positive relation, means as the risk is increasing, the return is also, as the beta is increasing, the return also is increasing, which is an indication of risk aversion. In order to take a higher risk, the expected rate of return should be higher itself, and if at all the risk aversion levels are more and more, the SML will become more and more steeper, means the market risk premium, or probably for every one additional amount of risk that I am taking, I need to be compensated with a very high return. So that is what will make this SML equation more and more steeper. Now, just a small understanding on beta. Beta, of course, it's the slope of the security market line. The way we are computing the beta is nothing but the covariance between the securities returns and the market returns divided by the variance of the market returns. We can take an example for that. So let's look at the calculation now. So let's say I have taken the monthly share price of some security, let me call it Infosys. I have taken the monthly share price of this, and the monthly share price, monthly index, which is the Sensex, right from Jan 2010. Now, when I am thinking of finding out the beta of Infosys, it is the covariance of the security returns to the market returns divided by the variance of the market returns. Okay, so for that, from the prices, I have to compute the returns. I am taking the returns of Infosys. So I can very well take it as this price minus the previous price divided by the previous price. Probably better to handle this in percentage form, right? So let me see, these are the returns, and probably convert them into percentage, giving me these are the percentage return. Similarly, I can talk about Sensex returns. Even there I'll do the same logic. The current price of the Sensex, subtract the previous price or previous index value, do the same and establish in terms of percentage. Fair enough. So these are the security returns as well as the market returns. Now I can find out the covariance between the security returns and market return. We have a procedure to find that, but yeah, I will directly use the Excel's formula to identify the covariance. So I will take covariance between the security returns, comma, the market returns. So this is the covariance that is existing between the security returns and the market returns. So it's showing some 0.001, and from this I can also find out the variance of the market return. That is coming out as the variance of the market returns. So this is the variance of the market return. So I'm dividing the covariance by the variance, giving me that the beta of Infosys, I should look at it as 0.73. Based on my analysis, the beta of Infosys is around 0.73. And how do I interpret it? Any beta greater than 1, it is above the average, the systematic risk is more than the market risk. So the return wise, I should expect a return which is more than the market return. But so those kind of stocks generally are cyclical. So with the economy, when the economy is really booming, they'll show a very good returns. When the economy is not doing that well, they show very pathetic returns. So those kind of stocks will have generally betas greater than 1, whereas the other ones where the betas are lesser than 1, we call them the defensive kind of stocks, wherein their expected return can be much lesser than the market return, which can mean they are defensive kind of stocks. So Infosys was falling more into this category because we are having a beta of around 0.73. Now in case, so using this beta of 0.73, let's say if I find out that the expected return of Infosys, assuming 8% risk-free rate of return, beta of 0.73, assuming market return is around 15% minus 8. So probably I can say the expected return from Infosys, let's say I'm just giving a quick number. So expected return should be around 13%. Whereas in reality, if the actual return is below the 13% mark, so as per the CAPM, Infosys is having a beta of 0.73, so the expected return should be 13%. And in case the return is less than 13%, somewhere here the actual return is existing, so that is where the return is lesser for this amount of risk, whereas this is the optimal. So it will lie below the SML, and any line below the SML is like, any point below the SML is like overvalued, means price is much higher. So it's better to go for a selling on that security, which will bring down its price. So the selling happens quite heavily, and on the other side, if the point is above the SML, there's a huge demand for that particular security. The point is very much above the SML, more and more buyings happen, so overall the return again will come back to the SML. So probably what you see is the based on the beta, this is the expected return. So generally it has to go up or go down accordingly. Now the interpretation from the beta we have already looked at, and so just to understand how we are able to differentiate the SML versus the CML, just as a quick understanding. So in an SML we are using, just as a couple of differences if I have to see, SML versus CML. In SML I am using only beta, whereas in CML I am using standard deviation on the x-axis. And in SML I am trying to find the returns on the securities based on their systematic risk, whereas in CML the intention is more for allocation of the assets, because I am looking at more from the total risk of the portfolio kind of scenario there. So here generally whatever the equation we are looking at as the CAPM, whereas here we call it here we are generally tracking it with respect to the efficient frontier, right? And when it comes to the slope, here we have called it as a Sharpe ratio, whereas here we called it as a market risk premium. So just a quick understanding of these things will give you the enough material to typically see in what case you have to go with the SML and in what case you are going with the CML kind of mechanism. So when we are going into this mean variance model to go ahead with the allocation of the portfolio or the creation of the portfolio, we are ending up computing n means, n variances, n into n minus 1 by 2 covariances, and then finding the betas of all. Probably the number of calculations or estimations that we are making is very high. Obviously, how many calculations we are making? N into n plus 3 by 2 calculations for mean, variance and standard deviations and covariances we are making, which can cause large number of inputs to come up and possibilities of heavy estimation errors also coming up. And for the determination of the beta itself, because beta requires covariance of securities to markets. So all these things will definitely require huge estimation error when we are going with this mean variance framework kind of a model. So that's where we are slightly moving into the other set of models which we call which we are calling as a market model, wherein instead of finding out these many, I can very well reduce the number of calculations that I can involve in this process. So that is what I call as the market model, so where we are looking at the risk. As I have identified earlier, we talk about the systematic risk and the unsystematic risk. Systematic is more present in the system, more present in the economy, which cannot be diversified, which is purely because of macroeconomic events, whereas unsystematic is purely because of firm specific events. So what we are trying to find out is the returns. So we have already computed the beta here, right? The alpha is another part, which is nothing but the intercept. Alpha is nothing but the intercept between the security returns and the market returns. So if I assume these are the security returns, so beta is actually the slope between the security returns and the market return, whereas alpha is the intercept between the two. Okay, between this return and this return. So once I have the data, now all I am saying is, yes, this is the alpha, this is the beta. So what is typically becoming as the equation for me in this case is the return of Infosys is equal to 0.0062. So probably let me reduce it. Okay, 0.62%. So 0.62% plus beta times beta, I'll take it to 2 decimals, 0.73 times whatever is the return on the market plus some error. This kind of a model that is getting prepared is what we call as the market model. 0.62% plus 0.73 times the return on the market plus some error. So, okay, let me try to compute this error in this case, which is nothing but the difference, the actual return on the market, right? Probably from here I should do the predicted return first. So what should be the predicted return on the security? Alpha plus beta times return on the market. So this is what is the predicted return. right? So as per this model, the predicted return is going to be something like this. So from here, if I want to find out what is the error in each of them, I can take it as the actual return minus the predicted return. So this is what is the error term corresponding to each. In some cases it could be positive, in some cases it could be negative. This is the error. Now, in some cases it is very high, in some cases it is very, very low. Now, what we are saying is, because of this model, till now, okay, I have found out alpha and beta. That's the only two things that I have estimated based on the past data for this. And what I am saying here is, once I know that alpha and beta, if I want to find out the expected return based on the expected return of the market. So markets, what is the expected return? Market average. I'll just take the expected return of the market. If I am taking, this is the expected return of the market. So expected return on the market, monthly average return of the market is 0.66%. Now what it is saying is, Infosys, if I want the expected return, I don't need to compute the expected return there. I'll use this model saying alpha plus beta times the market average. So that is how I can get the expected return on Infosys directly. So once I have predicted the alpha and beta, and once I know what is, so for each security, once I know alpha and beta, I don't need to estimate their mean. Once I know their alphas and betas, I can very well use the return on the market to find out what is their average return during the period. So the average return of Infosys during the period, monthly average is around 1.11%. Similarly, when I am looking at the variance, okay, the variance of the market, we have already got it. This is the variance of the market. Now, if I want the variance of Infosys, I can very well find out the variance of the market, which is, what is that? So if I want Infosys variance, I can take variance of the market into the beta squared. So variance of the market into the beta squared plus the variance of the error term. So I'll find out the variance of the error term first, error variance, which is nothing but the variance of this error terms. This is the error. This is a very big number this time. So variance of the error term, which is more and more specific to the Infosys actuals over the market. So this is what is the variance of the error term. So if I want Infosys variance, I am taking the variance of the market times the beta squared. So beta is already known, plus the variance of the market. So this is telling me that the variance of Infosys is around 0.73%. So a square root of that will give me the standard deviation of Infosys for this period. So I can find out the variance in this way, and the covariance, if I want, between Infosys and some other stock. All that it is saying is, take the variance of the market, take their individual betas and multiply it. That will give me covariance. So in this process, what all I need to estimate, I need to find out what is the return on the market, one, I need to find out what is the variance of the market. 2. For each security, I need to find out the alphas. So there are n securities, so I need to find n alphas. For each security, I need to find the betas. And for each security, I need to find out the error. So these are the things that if I know, I can calculate the expected returns, means, the variance and covariances, everything can be computed, which means overall I just need to make 3n plus 2 forecasts, not n into n plus 3 by 2. So I am able to reduce the number of forecasts that I am able to make quite drastically by resorting to this market model, and at the same time I can make the forecasts also quite comfortably, because the moment I know the betas and the moment I know the alphas, right, alpha, beta and probably the error, once I am able to know this, I am able to compute all the three, the expected return, the variance as well as the covariance with respect to any set of securities quite comfortably using this market model. So this is one more thing that we need to be comfortable with. Then the beta, whatever we are using for finding out the expected returns and the variances and all these things, the beta generally that what we are using is a historical beta. It is derived from the past, and so it requires some kind of adjustment because the beta is not consistent every time. So historical beta may or may not be a good predictor for the future expected returns, future variances and all. So generally it is understood that we need to make some kind of adjustments to this beta, because the beta, it is expected that it will follow an autoregressive process. It is expected that the beta will follow an autoregressive process. The beta as of the earlier period may not be, for each, whatever is the beta until the last month, probably this is, I'll do some kind of a regression by taking the data up to the last month and then including it as a part of the current month. So probably if I have to explain it slightly better, let me go back to this data. Let me take annual betas. Right, I'll not go with this beta. Let me take just a computation on an annual basis, or probably some last few data points. Let's say I'll start from Jan 1st here, Jan here. So whatever the earlier data I'll consider and compute the beta. So here I am saying beta is nothing but the slope, or I can take covariance divided by variance, whatever it is. Slope of I take all the data, right? I take up to here the securities returns. No, this is Sensex return. Let me take it from here. I'll take, let me make it slightly smaller. It gives me more better picture here. Okay, here I am taking the slope of the securities returns and the market returns. Only for this much period I am taking. Okay, so this is the beta that I actually got. This is the beta that I actually got in Jan 2012, and if I continue the same process, it is looking like, okay, the beta 0.89, 0.94, 95, 91 again coming down. It has come down to 0.64, even to the extent of 0.3s, and right now it's at a much lesser level. So the betas, whatever has been come out, probably if I assume that this beta is following an autoregressive process. So what I mean by the autoregressive process, I'll try to regress the current over the previous month. So these are the previous month's betas. So probably if I try to find the regression between taking this as the current and this as the previous, what is the slope I am going to get? The slope that I am going to get is slope of this comma this. So the slope I am going to get is somewhere around 1.04, and the intercept that I am generally getting okay, this is coming out to minus 0.06. The in reality, okay, this is a special case where we are not getting the slope less than 1, but in a very common case, what we'll get is the slope will be less than 1 itself, which is an indicator of mean reversion level, right? But here also, if I look at slope plus intercept, the slope plus intercept is still less than 1, which is an indicator of the mean reversion, right? And as we know, when I talk about the mean reversion level, when I am talking about the mean reversion, so beta 1 equal to alpha plus beta 0. This is what we were or probably alpha naught plus alpha 1 times beta 0. So now, because this is mean reverting, we say beta 0 equal to alpha naught plus alpha 1 beta 0. So beta 0 is becoming alpha naught by 1 minus alpha 1. That is what is the mean reversion level of beta. So here if I want to compute the mean reversion level of beta, it is coming out as alpha naught by 1 minus alpha 1. So this is coming out that the mean reversion level is 1.39. So in general, in a regular case, what we take is the beta will revert somewhere at around 1. So if it has gone more above 1, it will come back to 1. If it has gone below 1, it will go up to 1. So using this adjusted beta, using this particular process, we give some weightage 1 by 3. In common, what people take is without doing all this entire thing, as a part of adjustment, what they do is, if they want to do a forecasted beta for the next period, what they take is they do 1 by 3 plus some 2 by 3 times whatever is the beta of the historical beta that they have got. So this will be a much better adjustment of the beta, which will take it more and more closer to, under the assumption that the mean reversion will happen somewhere at around 1. But if we have ample data, we can even assume that the beta is following an autoregressive kind of a process, and based on that we can even get into the process of computing what is the mean reversion level and what are the values of alpha and beta accordingly. So this is the adjusted beta, which is worth using as a part of your expected returns or variances or covariances computing, and then going ahead for the calculation of the worth of the portfolio. Then the mean variance framework is assumed to be completely or to a large extent unstable, because the moment the securities returns, standard deviations change, the whole efficient frontier is going to change. Probably if the expected returns are going up, the efficient frontier is going to shift up, and if the variances are going to come down, the efficient frontier is going to shift to the left. So there is a kind of lot of instability associated with the mean variance framework, so which is giving rise to go to different set of models for creating the portfolios, and that is what is giving rise to the other set of models which we are going to discuss now, which fall under the category of multi-factor models. Alright, so let's get into those understanding of those multi-factor models now. When we look at these multi-factor models, at least our intention is we are focusing on more than one factor that can influence your returns, because in the market based model, which actually is called as a single factor model, we said return on the security is based on the alpha plus beta of the security times the return on the market plus epsilon. So this is based on the market returns, only one factor, right? But now when we are dealing with the multi-factor models, probably we are trying to expect the return on the security not just on one factor but n number of factors. So these are more and more enhancement over the single factor model, which was assuming only market was the major ingredient. So we see three major types of models which fall under this multi-factor model category. One is purely based on macroeconomic factors. So the return on the security is based on the various macroeconomic factors like inflation, the GDP, or the credit spread levels in the country. So it is based on various macroeconomic factors, but only the delta of them, deviation from the expectation. And instead of this alpha I, these factor models generally take the expected return, which is computed based on some stable model. Generally an arbitrage pricing theory kind of a model is being used. We'll discuss about it, wherein I look at, okay, if at all the economy is expected to have a GDP of 6%, the inflation of 4%, that is already figured into the return, expected return. Any unexpected part, it could be on the positive side as well as on the negative side. Any unexpected part of the various macroeconomic factors are what are deciding the additional return that can come up to the security. So those kind of models are working out as macroeconomic models. Then we also have another category of models on the same thing called fundamental factor models, wherein the asset returns are being looked at from the firm specific factors, okay, something like EPS or something like P by E or something like the debt to equity ratio, some such kind of fundamental related factors of the firm. We are trying to find out the returns on the asset based on the various fundamental factors. And the third set is going as statistical factors, where we'll use two major tools called factor analysis and principal component analysis, where the factor analysis identifies the covariance between the various asset returns, whereas the principal component analysis identifies the variance in the various asset return, together helping us to build portfolios. So we'll look at the statistical factors. They have a lot of ambiguity and complexity built into them, but we can try to understand the macroeconomic as well as the fundamental factor models to understand how they have improvised the basic single factor model. So when I go with the macroeconomic model, all I am saying is the expected return on the security is the expected return when no macroeconomic surprise exists, means this is already an expected return either determined through your CAPM model or in general more than a CAPM model. We'll try to find it using the arbitrage pricing theory model, which is purely based on the expectations of various factors, various economic factors which are expected. So any deviations from the expectation only. So some product of macroeconomic surprises means the deviations from the expected. So basically, if the GDP is expected to be 6%, but in actual it was proposed as 5%, it came out as 5%. So corresponding to that minus 1% of GDP, how would the return on this security change? So for the past few periods, we take what was the GDP for each of those periods and what was the returns. So this was the expected GDP, whereas this was the surprise. So corresponding to this surprise, what is the return that this security has generated? So I am trying to find out the sensitivity of the securities returns with respect to this macroeconomic surprise, and those sensitivities are typically categorized as different betas. So that's where let's say I generally categorize it like this: the return on the security is equal to the expected return when no surprises are existing plus if I am assuming two different factors, the beta corresponding to that first factor multiplied by the factor 1 plus beta the sensitivity to the second factor multiplied by the second factor excess plus so on, and some kind of an error term. This is how a multi-factor macroeconomic model is being designed. So the betas can differ for each of the securities because they act differently with different macroeconomic surprises. Because if there is a heavy inflation, some set of companies may be impacted, whereas some set of companies may not be impacted at all. So once I know the betas factor sensitivities to each of these macroeconomic factor surprises, here we have to only understand that we are talking about surprises here, right? So when I am able to find out the sensitivities with respect to each of those surprises, I can incorporate that into the model and compute the overall expected return. So most of these risk factors that I am considering here, probably this could be GDP, this could be the surprise in inflation, this could be surprise in any other things. So all those things we are still calling them as priced risk factors, means there is some amount of benefit that I am going to get by taking that additional risk, and the factor sensitivities are different to each one of them. In some cases it could be negative, means it could be if at all the particular factor has increased, it may reduce the overall return, increase beyond the expectations, it could reduce the overall return, or it could, if it is positive, it could increase the overall return. All those things can very well be modeled as a part of the factor based macroeconomic model. So here we are trying to find out the factor sensitivities and all using the regression model itself. The other set of models which we generally look at are the fundamental factor models, wherein we look at the model typically as the return on security is equal to some particular, I don't call it risk-free rate of return, whereas some particular return plus whatever is the factor sensitivities that I am taking. So let's say I am considering two factors again, F1, F2. I am finding out the sensitivities to each of these factors and the epsilon term. But the only difference here is the sensitivities here, they are not computed through regression. The sensitivities generally are computed as a standardized sensitivities. This is a very important word here. I am taking standardized factor sensitivities here. So let's say I am taking a factor called P by E ratio. What I will take is the standardized factor sensitivity will come out as just like a standard normal distribution. What is the factor value for this particular security minus what is the average factor value for the list of stocks which I have considered, divided by what is the standard deviation of the factor which I have considered across all the security. So this will give me the standardized factor sensitivity. So this is not determined by regression, this is actually determined by this kind of a framework. So the standardized, if I am taking P by E, P by BV, P by S, whatever are the values which I am considering, or probably if I am considering the size of the firm or the revenue growth, any kind of factor which I am considering, I am taking the value of the factor for this particular security minus the average divided by the standard deviation. That's how I am standardizing the sensitivities, and that sensitivities are multiplied by factor returns for all fundamentals. When I say factor return, this is also an interesting part. Factor returns are the rate of returns associated with each of the factor, and the way we are trying to find them out is you take the returns of all the securities and the standardized values of all the securities. So we know this, the standardized values are computed through this process. So if the standardized values are something like this and the actual returns are something like this, the slope between this, I am doing a regression of this on this, the slope whatever comes, that slope is what I am taking as the factor return. The slope of the actual the regression of actual returns over the standardized securities is what I am taking as factor returns, and they are also not estimated, they are also computed. So this entire set of values are actually computed, and once I have done all that, this intercept term is nothing but whichever that particular rate of return that makes the unsystematic risk as 0. So which is like a fully diversified. So it could be a positive value or a negative value. I don't call it as intercept, or I don't call it as company specific risk. Whichever that particular value that makes the unsystematic risk equal to 0 is what we are going ahead in the fundamental factor model. And in this case I can take any number of factors, no restriction, and I can create as much of heavier model as possible. And couple of things, okay, even if I have to look at finding out the sensitivities, it's easier to compute, and even when I have to look at the returns, the returns is a very tedious aspect, because for all the securities I am trying to find out their standardized sensitivities, and based on that regressing them against their actual returns, which is what is a tedious process. But yeah, that's the way to find out what were the expected returns for the security. Then getting into the next model in this scenario, which is called as arbitrage pricing theory model, which whose output will go as input into your regular macroeconomic based multi-factor model. There are this also goes with a multi-factor itself, and it makes a very straightforward assumption that the unsystematic risk is completely diversified. That's the reason you are finding in the equation of the model we are taking risk-free rate as the intercept, because it clearly assumes that the unsystematic risk is completely diversified and no arbitrage opportunities exist. So this is what, okay, beta 1, lambda 1, beta 2, lambda 2, looking like more or less as any other multi-factor model itself, but the only thing is here the lambdas are the risk premium for each factor. So let's say this is inflation, right? What is this? So the way I get the lambda here is the risk premium. This is not increase in inflation. So this is the risk premium, wherein all these factor sensitivities are set to 0 and this factor sensitivity is set to 1, and finding out the return. So let's say the return of this security is 10% and risk free rate is 8%, and the beta is set to 1, and this is taken as the risk premium. So the risk premium directly is coming out as 2%. So the lambda 1 is set as 2%. Like that, for each of these things, the lambda is decided based on the risk premium, where that particular factor sensitivity is 1 and for all others it is 0. So you can take each of them as the market portfolio or market portfolio, or need not take it as a market portfolio. But when you take this, one of this is market and probably ignore all of them, this is what is nothing but your CAPM kind of a model. But the key thing which you have to understand is the APT is a cross-sectional model. Means at one single point, by knowing the lambdas of different companies, I can find out the expected returns for the different securities. Whereas in regular multi-factor model, whatever macroeconomic and all whatever we have used, they are all time series based models. Means for a particular security across the time, I am able to forecast the return. But here this is a cross-sectional model. For a particular time, I am able to work out with the returns for multiple securities. So this is why we call the arbitrage pricing theory model more of cross-sectional model, not a time series kind of a model. And it's an equilibrium model, no arbitrage. So whatever the returns that are going to come out are, and if at all any arbitrage exists, the buying and selling happens. So just like a CAPM model, it's a no arbitrage based equilibrium model, whereas when we look at any of the macroeconomic kind of model, they are more of statistically data adjusted kind of models. And as I have already indicated, the intercept in the multi-factor model is derived from the APT equation itself. Whatever the expected return that comes in this arbitrage pricing theory model, that goes as the intercept in the macroeconomic factor based models. And now looking at this aspect of, if at all if at all any portfolio manager wants to take excess risk and to generate additional return, how do I typically evaluate that and how do I measure the performance of the portfolio manager? So for that we define two terms called active return and active risk. So whatever the return your portfolio has generated over a benchmark, that is what we call as active return. And whatever regularly at regular periods of time I take the differences of the portfolio return above the target or benchmark return. So these are the active returns, maybe positive, maybe negative for some periods. So these are the active returns over the different periods for this security. I take the standard deviations of these active returns. That is what I am calling as active risk, or sometimes we even use the word called tracking error. And this could be because of two things. One is the factor risk. Means okay, I have selected 2, 1, 2, 3, 4, 5 securities. I am changing the weightages across these factors. That is what is contributing to factor risk. Or within each of these factors itself I am doing changes. That is what is being contributing to the specific kind of a risk. And when I am talking about the total active risk, I am considering factor risk plus the specific risk. And as a part of this process, we are very much interested in computing what is called as an information ratio, which is nothing but active return by active risk. The higher it is, the better it is, because for 1 unit of risk that I am taking, for 1 unit of additional risk that I am taking, I am able to generate a much higher return, much higher additional return, which is what will become a better tool to assess the performance of a portfolio manager. It is same as your Sharpe ratio itself, but in Sharpe ratio we have taken it as return of portfolio minus the risk-free rate of return divided by the standard deviation, whereas here we are calling as return of the portfolio minus the benchmark by we are doing it as standard deviation of the differences. That's the only thing, but at least it is a reward to risk kind of a ratio itself. So that is the reason it is more and more similar to the Sharpe only, except for if I take the benchmark return to be more or less similar to the risk-free rate of return, then probably to a large extent it gets equated to the Sharpe ratio itself. But from an interpretation standpoint, the higher it is, the better it is. So from an evaluation perspective also, any portfolio manager who is having the highest information ratio will be chosen over the other. So this is what we look at as a part of the concepts of the portfolio management. I hope all these things are comfortable with you and you are able to understand this concept of portfolio in a great deal. Any issues or any clarifications you require on the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.